I'm going to move around a little bit. Is that okay with the camera? I know you have to film it, but
Turn the light off?
that'd be great if we can turn the light off. Thanks, Dr. Liu, and thanks for the opportunity to be here today.
Not for the camera.
I'm sorry to interrupt this, but I need sorry.
Okay. I just want to make sure you can see parts of this. Okay, fantastic.
Students have good eyesight still.
Okay, good. Hey. All right. So I'm Hank Watkins here from New York. Sorry if you were expecting a British accent. Tony Joseph is back here. He's my colleague in the Los Angeles office. A lot of years in the Lloyd's market. He is British by birth. So, Tony, welcome.
Thank you.
And the rest of you here in the room, I'm thrilled to be here. I understand you're from the worlds of finance, risk management, actuarial science, and everything, so hopefully I'll touch on enough things about the Lloyd's market that'll be of interest to you. But if you have questions, I'm happy to answer them towards the end. If any burning questions come up, just raise your hand and I'll call on you. So Lloyd's of London, have you all heard of Lloyd's of London? The kind of things we do, you probably think about body parts, singers, voices, people's hair, that kind of stuff. That's a little bit of what we do. I'm going to talk about today about a lot of different things that Lloyd's is up to. The title, Innovation, Resilience, and the Future of Risk. So essentially I'm going to talk about Lloyd's, what makes us unique, financial results, obviously very important for a marketplace like ours, what we do in the US, a little bit on emerging risks. For those of you in the insurance part of this, emerging risks are what makes our industry tick. You know, we all have grown over the past many years by finding out what's around the next corner, what might make your clients and prospects nervous, what might keep their business behind, and you find out solutions in the insurance industry to help transfer the risk from them to us, and in essence become a valuable business partner to them. So we love talking about emerging risks, Global Underinsurance Report, and then our Vision 2025 for the future. This is the Lloyd's building in the heart of the city of London. It's a Richard Rogers creation. He's the same architect that did the Pompidou Center in Paris and is doing the new Aon World headquarters across the street from us in London. Essentially, you either love this building or you hate it. It's in a normal building, things like the elevators, the stairwells, the bathrooms, the HVAC equipment all hangs on the inside. In this building, it all hangs on the outside. It makes it very efficient from a use of space perspective. It's a 12-story building. The first 4 floors are what we use for the underwriting room. Now, so what is Lloyd's? That's the building. If you were to believe Leader's Edge, which is the monthly publication of CIAB, the Council of Insurance Agents and Brokers in Washington, D.C., it's the epicenter of global reinsurance and insurance. Now, the Lloyd's building itself is right in here, and surrounded in about a square mile area, there's about $70 billion in reinsurance and insurance transactions annually that take place there. They say if you can't get it done in London, you can't get it done anywhere. It's a fantastic place. Or you can think, which I do, that it's the best known, least understood brand in insurance. Everyone's heard of us. Not a whole lot of people, unless you work in it every day, truly understand why we're relevant. Real quickly, now I have very few slides with words on them, so don't start panicking and leaving the room. But Lloyd's is a marketplace, it's not a company. We're not an insurance company. If you get a policy from Lloyd's, it has the various syndicates that are supporting the risk on the policy. It doesn't say Lloyd's Insurance Company. Long history of taking risk going back to 1688. We're one of the longest surviving business operations anywhere in the world. We insure primarily complex and specialist risks. It's based in London. And it's, again, goes back 326 years. We have a performance management directorate, which does a fine job of ensuring that all the business that's written in the Lloyd's market is well reviewed and monitored throughout the year. We're heavily regulated. Those of you getting into the insurance industry, actually any business in financial services these days, you'll know that regulation since 2008, 2009 has dramatically increased globally. Now, we're big fans of regulation as long as it's appropriate regulation. The biggest challenge we have in the insurance industry in general is that regulators tend to batch us with the banks. The banks are the ones that essentially got into trouble. If you look back, since 2007, 2008, when the financial crisis really got started, over 200 community banks went out of business. If you look at all the insurance companies globally that went out of business, very few did, and it was for reasons that they would have probably gotten in trouble for anyway. AIG Financial Products, not even part of AIG's insurance company, were the ones that issued those credit default swaps to protect the banks. Because of that, Because of that, the banking regulators tended to lump the insurance industry into the same bucket as them. So we've tried very hard, with not a whole lot of success as an industry in general, and Lloyd's in particular, to convince the regulators that we are separate businesses, that we're not systemically important institutions, we're not SIFIs. But it hasn't worked for some organizations. Prudential, MetLife, and AIG most recently have been qualified as SIFIs by the federal government, which requires them to put up a lot more capital to write business than they normally would. But anyway, so we're heavily regulated. Regulation's a good thing if it's appropriate. And then the most important thing for the brokers and the cover holders in the room, we distribute our products through you, Tim, and Hank. We're not a direct marketplace. Strengths, financial security, I'll go through that in a bit, underwriting expertise, access to business, brand and reputation. This is huge for Lloyd's. 326 years of building it, it can vanish overnight. So that's something you're all probably thinking about as you get into your own business careers. Your personal brand is critical. Obviously, you take a lot of years to build that through your education, through how you act around others, what you do when no one's looking. You've all heard that cliche. But it's critical because you can wreck your personal brand, you can wreck your corporate brand with one bad move. So something to always keep in mind no matter what you're doing. This is the inside of that building. Again, the first 4 floors are the underwriting room. There are about 91 syndicates in this building that write all types of insurance risk: energy, marine, aviation, property. The Lloyd's market is famous for writing catastrophic property risk. We write about half of our cat business comes from the U.S. It's a big part of our business. So when the earth doesn't move and the wind doesn't blow, Lloyd's makes a lot of money. When we have years like 2011, when the global crisis, basically nature turned against us. We had tsunami in Japan and that earthquake, a big tragedy for them. We had the floods in Thailand, which started in June and ended in December. Had Australia floods, New Zealand earthquakes. A lot of things happened, conspired against humanity, and the insurance industry picked it up. So that was a tough year for Lloyd's, tough year for the whole industry. Oh, by the way, a little bit of history. This is called the rostrum, and right below that hangs the lutein bell. Historically, when a ship didn't come back, because ships and cargoes were what Lloyd started insuring for the first few hundred years of their existence, when a ship didn't come back on time, the bell would ring, and all the underwriters who wrote that risk would come shuffling over with their checkbooks. Great, I'm going to have to insure this thing that went down in some far-off ocean. They would always hope for the ship to come back a couple days late because then the bell would ring twice. And so that's sort of a little bit of historical perspective on Lloyd's. It's not rung very often anymore. It's perhaps rung on the 9/11 anniversary and on the Queen's birthday, but not more often than that. This is a close-up of that underwriting floor. Advent is, to give you an example of the types of business and types of capital that are invested in the Lloyd's market. This is owned by Fairfax Financial, which is a Canadian financial services company, and they're writing business in the Lloyd's market. The beauty of this marketplace is that most of the business is done on a face-to-face basis. We're not big fans of online insurance. Geico, you got 15 minutes, save you 15%. It's a great business plan for them. It works really well for Warren Buffett, but it's not something Lloyd's does. It's because we do complex and specialty type risks, aviation, satellites, oil rigs that are drilling 5 miles into the ocean floor. That business has to be transacted face to face. It is complex. Most important thing about insurance, as you know, is when there's a claim, are you going to get paid? So if you've got a complex risk, you want to put someplace where the underwriter you've met, you've looked them in the eye, is going to pay your claim, you come to Lloyd's for that. Around that square mile of the Lloyd's building, you've got the world's insurance companies, all well-known brands. Got AIG here. They've got a Lloyd's syndicate. Beazley, the big British company with a couple of Lloyd's syndicates. XL, ACE. Swiss Re is not in the Lloyd's marketplace. I just put that there because we have both the Lloyd's market and the London market around us that are our competitors, but we also partner on major risks that can't all get done in Lloyd's. Again, if you can't get it done in this square mile around the Lloyd's building, it probably can't be done. And brokers. There are over 200 Lloyd's brokers within this city of London that actually bring the business into Lloyd's. I've got a chart in a second that shows you how the process works, but these are some household names as well for the brokers in the room. Again, I mentioned within the Lloyd's marketplace, there's about $75 billion in premium that's written annually. Lloyd's is $38 billion of it. and the rest of the market's about 36. This is a quick snapshot of some of the managing agents in the Lloyd's market that actually run the syndicates for us. You have some household names. Where's Chubb? There's Chubb. They have a syndicate they started a couple years ago. Travelers has a syndicate. XL. And then a lot of these names you may not recognize because they could be British companies that you've not heard of, but they've been in the Lloyd's market for many, many years. Some of them are like ANV, which is now funded by a Canadian pension fund. So there's a lot of ways that people get into the Lloyd's market and either set up new syndicates or fund existing ones. There are 57 managing agents. They run 92 syndicates. Now, cover holders are an important part of this. If you, Tim and Hank here, Tim Shea and Hank Haldeman, they're with wholesale brokers that are also Lloyd's cover holders. That means they have binding authority. So one way that we very efficiently distribute our insurance and reinsurance products around the world is through cover holders. They're people that we trust and have given binding authority to. So if you're a retail insurance agent bringing your client's business into the marketplace, you don't have to go to Lloyd's all the time to do that. You can go to see Tim or go to see Hank, and they in their office can actually bind coverage for you. About 40% of our U.S. business comes to us that way, the E&S business, and about 30% globally is how we get our business. It's a great distribution network for us and has been around for hundreds of years. Capital into Lloyd's, for those of you in finance. The anemic interest rate environment we've all been living through the past several years has greatly increased the attraction of the Lloyd's market and the insurance industry in general to capital. If you look at our returns, in 2009, Lloyd's returned about 24% on capital. We didn't do as well in 2011 because of all the nat cats, but the rest of the industry didn't either. This year through June, we're at about 16.5% return on capital invested. Now you compare that to any other place where money's invested these days, it's a much lower return. So the insurance industry in general, Lloyd's in particular, have been very popular places for all types of investment capital, whether it's from pension funds, private equity firms, other insurance companies, etc. Our capital, historically, this little sliver here was from names. You may have heard the term names. These were people who pledged their unlimited personal liability to the Lloyd's syndicates they were supporting. We had about 30,000 of them prior to the 1980s. We currently have far fewer, and only about 3% of all capital now invested in Lloyd's comes from unlimited names. Part of the title was on resilience. I'll go back a couple years, late 80s, early 90s. I was actually a broker then, and Lloyd's got into a lot of trouble. They underestimated the U.S. litigious environment. They didn't truly understand how the environmental and asbestos type claims that were coming up through the years were going to impact the overall economy and overall insurance marketplace. So Lloyd's got tagged with a lot of environmental claims. Remember the Superfund? Well, maybe you don't. But Superfund was some legislation that enabled the federal government to fund a lot of cleanup of environmental sites that has historically caused a lot of problems. A lot of that was claimed on the back of insurance companies. Asbestos, of course, that's been a terrible created a terrible toll on a lot of people's health over the years. Lloyd's insured a lot of the manufacturers of that, as did the rest of the industry. Then we had the Hurricane Andrew tragedy in Florida and the Piper Alpha oil platform disaster in the North Sea. A lot of things happened over 3 or 4 years that caused the Lloyd's market to almost go out of business. When I was a broker for Johnston & Higgins in the early 90s, Time magazine put out a cover that said, "Lloyd's of London, rest in peace." Now, if you're a broker trying to convince your clients to stay with the insurance market after that's been published, it brings out the best of your sales skills. So long story short, Lloyd's got through all that trouble. They created a reinsurance vehicle called Equitas, allowed them to dump all the pre-1993 liabilities into that vehicle, and ultimately we sold it to Warren Buffett. And so he's got that to worry about. Lloyd's from 93 forward has been able to go ahead without any legacy liability. So very, very important part of our survival. The most critical part of that was that we did it without government intervention. No bank loans, no government loans, got it done with on the backs and support of all the members of the Lloyd's marketplace. So very important piece. I keep pressing this subconsciously. You're not telling me that I'm almost done. So not to belabor this slide, but the capital now, because of all that trouble that the unlimited liability names had. You had thousands of people losing everything back in the early 90s to pay the claims that I just talked about. Lloyd's no longer allows individuals to come in with unlimited liability and invest in Lloyd's syndicates. If you want to do that, if you've got a lot of wealth and you want to put it into a Lloyd's syndicate, you have to become an LLC. More commonly now, most of the capital comes from corporations, from pension funds, from private equity firms, people who have an appetite for risk, and if they lose in a particular syndicate in a given year, aren't going to lose everything. So this wheel just shows you the capital from around the world. Munich Re is interesting because very traditional German reinsurance company. They actually have 2 syndicates at Lloyd's, and one of them does the wackier things I'm going to show you in a second. So it's the advantage of being in a market like Lloyd's is no matter where your capital is being invested from, if you're someone like Chubb, pretty conservative company, not a tremendous global footprint, they got into Lloyd's because it allows them to write some of the business, E&O, D&O, et cetera, they maybe didn't have access to overseas through the Lloyd's platform. So there are a lot of reasons people get into Lloyd's and a lot of reasons most of them stay. Global reach, the US and Canada, about 43% of Lloyd's business, and that makes sense because a lot of the more complex risks that have come out of business and industry developing over the centuries has come from the US. It's a big part of our business. 15% in Europe, 18% United Kingdom, and the rest in the world. We're growing quite a bit in Central Asia. We just got licensed in Beijing. We had been licensed in Shanghai before that. Now, China is a real challenging marketplace for any non-Chinese insurance organization because it takes you a lot of work, many years to get in, to get licensed, and ultimately, it's a long-term play. You're not going to write a lot of business and make a lot of money for probably decades, but you have to be there. And so we're thrilled to finally be there. The other aspect of doing business in China is that culturally, they don't buy a lot of insurance. And so if you're in the business of selling risk transfer products, in the countries you're going into with massive marketplace doesn't have a real culture around transferring your personal or your corporate risk to insurance companies, you have a long way to go to get there. So we're all working very hard to increase education around that and ultimately take the burden of natural catastrophes off the Chinese government. You look at the Sichuan earthquake in 2008, a real tragedy. The bulk of that economic loss was paid for by the government. A very small percentage, less than 2%, was paid for by the insurance industry. Our argument is that, not unlike flood in the U.S., the flood program in the U.S. government is almost $30 billion in the red right now, because if you have a mortgage in a flood zone, you have to buy flood insurance. You typically buy it through the U.S. Through an insurance company that's reinsured by the U.S. government. So all that flood risk ends up back in the laps of taxpayers. It's been massively, the pricing on it, the modeling has been well below what the insurance industry itself would charge. Because of that, the taxpayers now are up to about $30 billion in the red on that program. So that's another example of why can't the U.S. government, the taxpayers, use all that money we pay in claims for flood losses and build hospitals, build schools, rebuild our infrastructure. It's political. So whether it's in the U.S. with the flood program, in China with a lot of their approaches to ensuring nat cats, it's a real challenge for our industry going forward. Now I pose that as an opportunity for all of you in the room who are in the industry, because it's your chance to get out there and educate governments, educate people on why they should transfer their risk from themselves and worry less about where they're going to pay for those claims because they have an insurance program in place. So good opportunity for all of you. How's Lloyd's unique? A little bit on history, just one quick slide on that. Started in 1688. Cuthbert Heath was the father of modern day reinsurance. 1906, that was the San Francisco earthquake. Now, Cuthbert Heath was in charge of a lot of the reinsurance that was protecting the city. He saw an opportunity, a major tragedy in a U.S. city, and he said to all of his adjusters in the area, said, pay all claims regardless of their validity. Now, we don't do that today because we'd be out of business, but that's something that was very important. He saw it as an opportunity to establish Lloyd's, a UK insurer, in the US marketplace by rebuilding San Francisco. So that's a great story. 1925, the Central Fund was established. I've got more on that later. 20s and 30s, Lloyd's established its only licensed platforms. We're primarily E&S. Do many of you get involved in surplus lines and E&S? You've heard about it, probably. Maybe not. I know, I know a lot of the focus is on licensed insurance companies, Travelers, Hartford, a lot of the companies that you're probably talking to about getting jobs. That whole industry in the U.S. is about $500 billion in premium annually. The surplus lines place, which is where Mr. Haldeman and Mr. Shea play, is about $35 billion, give or take. I'm probably being a little optimistic, but it's growing. But it's 10 or 15% of the entire marketplace. So an exciting place. We'll probably talk about that in the panel later. But bottom line is Lloyd's has 3 very small licensed platforms, Kentucky, Illinois, and the U.S. Virgin Islands. The rest of what we do is either reinsurance or surplus lines. And in 1939, World War II was getting started. The U.S. government said to Lloyd's, we like the Brits. You know, we've known each other for centuries. We trust you, but you've got a big bad wolf coming at you. And if you don't get through this, we have a lot of our citizens insured by Lloyd's of London. And how are we going to get paid if they have claims? So Lloyd's established the U.S. trust funds back then, which have now grown to about $12 billion, which is kept at Citibank in New York. So all that money is actually supporting the E&S and the reinsurance risks that we take in the U.S. Very important part. What can be insured at Lloyd's? Okay, these are the things that most people might think of us for. You know, aviation, satellite risk. We insure about 25% of the renewable energy, wind farms, tidal, and solar farms around the world, actually. If you drive east to Palm Springs, you ever done that and almost gotten mesmerized by those spinning turbines that you crashed? I have. And Lloyd's insures a lot of those. It's a big, big business for us. Obviously, windstorm is critical for us, a lot of shipping, aviation. I put this up here because the 2010 Transocean disaster in the Gulf, the BP rig that sank, that was insured by Lloyd's. So when that thing went under the waves, we wrote a check for about $350 million within about 2 weeks. You know, it's one of those things, if something's destroyed, and it was a major tragedy, obviously, but we insured the rig itself, we paid the claim, and off we went. Now, we're able to survive after paying a massive claim like that because we had 10 or 15 syndicates sharing that risk, and they reinsured a lot of that outside of Lloyd's as well. But we're also insuring hundreds of these rigs around the world every day, and so chances are they're not all going to go down. Very few do, fortunately. We also do some wacky things, you know. Sommelier's nose. If he didn't have his nose, how could he sniff the wine? Any Pittsburgh Steelers fans in the room? Come on, nobody moved here from Pittsburgh to go to school in Southern California. Troy Polamalu washes his hair on TV and plays a piano in a tux. You ever seen that? Come on. Humor me. Head and Shoulders bought a policy from Lloyd's to protect their investment in his hair. So we do that. Ugly Betty Smile, Christina Ferrer. Crest bought a policy for that. Keith Richards' hands. Who knows who this is? And if you're over 25, you can't answer. Betty Grable. She was a starlet, but you're barely over 25. But she was a starlet in the 40s, and she insured her legs at Lloyd's. Now, since then, a lot of actors and actresses have insured their body parts at Lloyd's. That's what Munich Re does a lot of. They have a Watkins syndicate, no relation, and they do that. Grady White, Santa Claus at Macy's, got his beard insured. And this time of year, we get a lot of calls for vampire bite insurance. So nobody seems to want to buy the policies, but we do get a lot of calls, seriously, people looking more for fun, for a joke, you know, have a policy from Lloyd's, and we don't do it, but it'd be something it might be fun to bring to a party one day, right, on Halloween. So a lot of interesting things on at Lloyd's. Business streams, very important. Without losses, none of us would be studying insurance. I wouldn't be in the business. So the people who buy insurance and reinsurance are the first, most important part of this chain. Then we've got the capital providers. I talked about them a little bit. Mostly it's corporate capital that comes in now and invests in the Lloyd's syndicates. There's a little bit of non-corporate, but very, very limited. They support 57 managing agents that are running 92 syndicates. And again, the classes of business are marine, energy, aviation, property, contingency, which is that crazy stuff I just showed you. If you're an insurance buyer, you would get to the marketplace generally, unless you go on geico.com, through a retail broker. There are hundreds of them around the country. They would generally get to the wholesale insurance marketplace, not just Lloyd's, but the wholesale marketplace, through either a wholesale broker, or we call it a cover holder, but a lot of insurance companies outside the Lloyd's market, our competitors actually have binding authorities as well. They don't call them cover holders, that's a Lloydism. If you're an insurance company and you're buying reinsurance, which they all do, spread the risk, critical component of insurance, you would go to a reinsurance broker, and ultimately, they'd go into a Lloyd's broker. Sounds really complicated, doesn't it? It's really not once you've done it a few times. But the Lloyd's brokers are the ones that are primarily based in London. They spend their whole day understanding how the Lloyd's market works, because it's a dynamic place. 92 syndicates doing all lines of business. They're the ones that know the market best. And then the Corporation of Lloyd's is who I work for. That's who Tony works for. We're essentially we're a classic turnkey operation. So if you're a capital provider and you bring in underwriting expertise and you want to write a certain class of business around the world, you can come to Lloyd's and you pay us a certain amount of money to do that. We do the rest. We set up your licenses around the world. We enable you through branding and marketing to be well known overnight. We do all the regulatory affairs work for you. We help you with the claims processing, the premium collection. Pretty much everything you'd have to do as an insurance company that would take 5 years on your own to get traction, you can do it in the Lloyd's market almost overnight. Now, to get into Lloyd's, it's a long process. It can take anywhere from 6 months if you're just investing in a Lloyd's syndicate, or it can take 2 years if you're starting your own syndicate from scratch, which people like Chubb did. So there are a lot of different ways to get into the Lloyd's market. If you're interested, there are varying degrees of time commitment and financial commitment it takes to get there. But once you're in, it's a very efficient use of capital, and it's a very effective way to get your brand marketed around the world and start running business pretty quickly. Now, exposure monitoring, this is a process that's critical. How does Lloyd's make money year in and year out, other than 2011, when nobody in the industry made money? Every year around July, we have each of the syndicates that are in the Lloyd's market present their business plan to us in London. And then over the next 6 months, we go through a process of reviewing it very carefully. We want to make sure they have underwriters who understand the risk, that their rate structures are appropriate, that they've got experience paying the claims in the past, that they, in essence, know what business they're going to write. That whole process takes 5 to 6 months, a lot of back and forth. Once we all agree, then as of January 1, they can start writing their business plans. And then every quarter for that year, we monitor them to make sure that they're doing what they're supposed to do. People being people, you may sometimes get a risk in from a broker that's a little bit outside the scope of your business plan, and if you think no one's looking, you might take a chance at it. Now, we don't catch everything, but we do our best to understand what they're writing, because bottom line is, if one syndicate or 2 syndicates go sideways out of business, the whole marketplace is mutualized, and that we protect each other through the central fund. It would require all of the different members, all the 92 syndicates, to pitch up and pay for those 2 guys' losses over there. So, very important part of this whole process is the performance management piece. I'm going to keep going. That's modeling. Financial security. I won't read this, but there are 3 links in our chain of security. Very, very important, especially if you're selling Lloyd's. The first one is the syndicate level assets. We've got about $70 billion that's in place. The syndicates have to put up to write business that protects their writings. Then the second link are the members' funds at Lloyd's. These are the investors in the Lloyd's market. They put up an additional $25 billion to support the syndicates they're writing. You can't write insurance anywhere in the world unless you've got a ton of capital behind you. You probably have all learned that. It makes a lot of sense. The third link, which is critical, gosh, is he done yet? No. Third link is our central fund. This was established in 1925. This is what makes Lloyd's a mutual marketplace. Every member of Lloyd's who's writing business there, every syndicate has to annually put up a certain percentage of their premium to support this central fund. And it's there in the event that a syndicate writes business, gets in a world of trouble, and goes out of business. A couple of examples recently are we had a syndicate writing med-mal business in Italy. They got whacked big time. They basically they paid all the claims they could, they paid all the claims they could, and then they went out of business. So they had claims that weren't paid. Lloyd's picked that up through our central fund. We also had a syndicate named Argenta that started writing catastrophe property business in Thailand in early 2011. And I mentioned earlier, around June through December, that whole country flooded. So they lost everything. They went out of business, put their hands up, said, we're done. They still had a lot of claims that weren't paid. So the central fund was tapped to pay those claims. The important thing here is that if you're with a Lloyd's syndicate and they go out of business, which rarely happens, you have the central fund, which is about $4.5 billion now, backing that up. So very, very critical. Just real quickly on the E&S comment, if you're a retail broker, you've got a client, and they've got a pretty specialist or unique risk, and you want to take it to the excess and surplus lines marketplace, your competitors who are only accessing the admitted marketplace might say, it's not a good bet for you, Mr. Client, to go to the E&S side because they don't have access to a state guarantee fund. Have you all talked about state guarantee funds? You know that if you buy a policy from an admitted carrier and they go out of business, the state guarantee fund is supposed to step up and pay that claim? Well, that's normally what happens. In the E&S marketplace, because we aren't licensed, we don't have any state guarantee funds protecting us as a whole. The Lloyd's market, though, has this $4.5 billion central fund, which is in essence stronger than any state's guarantee fund, probably stronger than all 50 of them combined, if you look at it. So it's a very, very strong selling point that we have. If a syndicate goes out of business, we pay the claims out of that fund. Now, I'm going to have to walk over here, and hopefully this will work. Results. The only reason I have this slide up is that it shows you a 5-year run of the Lloyd's marketplace, what we've done. 2009, we wrote $35 billion in premium globally. Combined ratio was 86%. That's pretty good across all the lines we do. Investment returns were excellent at almost $2.8 billion. Our return on capital was 24%. Incredible. You know why that was such a good year? Because nothing happened anywhere. The earth was very quiet. Seriously, nothing happened. 2010, where we ended up with only a 12% return on capital. 2010 started with the Chile earthquake. We were big players in that. Then we had floods in Australia, earthquakes in New Zealand, a lot of U.S. tornadoes in the middle of the country. Lloyd's plays a big role in the reinsurance of that. So a lot happened in 2010. But still, a 12% return on capital was pretty darn good. 2011, I already talked about that. I mean, you can count the number of tragedies there were. We lost 3% on invested capital. So not a great year for us or anybody in the marketplace. 2012 kicked off really well. We got till about October 29th, feeling pretty good about ourselves, and then Superstorm Sandy hit. And that was about $2.5 billion to Lloyd's alone, about $25 billion to the entire marketplace. So it tagged us a bit, but we still returned almost 15% on invested capital. 2013 was a pretty good year for us. 86% loss ratio. So not a bad year at all, 2013. I'm showing you these ratings because they're very important. Lloyd's wasn't rated until we went through our reconstruction renewal process that got us out of that trouble in the early 90s. We're now rated A+ by S&P, AA- by Fitch. That was just increased last year, and A by AM Best. You may be thinking, gee, ratings mean nothing. Look what all the banks were rated so well during the crisis. But they're critical to us because without ratings, we'd have a much harder time writing new business. And results through June 30th of 2014, just real quickly here, about 88% loss ratio. Investment capital, actually investment return went up quite a bit from a year ago this same time. It's almost by a full percentage point. So the market has turned up a little bit for us. The equities market is up. We're making a little more money in the investment capital. Still not enough to write home about, but it's better than it had been. Return on capital, again, 16.5% through June 30th. So I probably just jinxed myself because hurricane season isn't over yet by a long shot. Lloyd's business in the U.S., 52% is surplus lines, also known as E&S. 38% is reinsurance. 8% is exempt. That's the kind of business that we don't have to report to any state stamping offices. It's like marine builder's risk, a lot of the cargo type business we write, but it's still a big chunk of our income. And I mentioned those 3 license platforms, Kentucky, Illinois, and USVI. That's about 2%. And this is just a breakdown of the business that Lloyd's writes across the U.S. Half our business is property. We're not looking to write new property business because a lot of that's in the Gulf, a lot of it's in Florida. It's cat. When nothing happens, we make money, but when it does happen, watch out. I mentioned earlier the admitted marketplace in the U.S. is about $500 million in premium. Lloyd's has a very small piece of that through our 3 platforms. E&S business about $34 billion in 2013. Lloyd's writes about $7 billion of that, so we're a big player in E&S. And then reinsurance, the U.S. marketplace is about $47 billion. Lloyd's writes about $5 billion of that. I hate these kind of slides. There we go. E&S. I like this slide because it shows us as number 1. AIG was number 1 for a long time through the Lexington subsidiary based out of Boston, but they got in some trouble, as we all know, so they've lost some business. They're coming back really strong, a great competitor, but they're number 2 as of 2013. The reason I like this slide is because it shows you the bulk of these competitors, whether it's Berkeley, Markel, ACE, Fairfax, CNA, and QBE, are also partners in the Lloyd's market. They all own Lloyd's syndicates. So we compete against them here in the U.S. They own Lloyd's syndicates that they actually use to access business from other parts of the world. So it's a unique marketplace, nothing else like it in the world, where you can be partners and competitors in the same room. We grew in E&S last year by 13%, so we're very, very proud of that. Top 10 states for Lloyd's in the excess and surplus lines marketplace. Based on what I've been talking about, you can probably guess, it's California for earthquake, Texas for a lot of the energy business, Florida for windstorm, the entire Gulf for energy and windstorm, all the way up through Maine. Our largest state is by far Texas. We're the number 1 E&S writer there. California is number 2, Florida number 3. So we're trying very hard through our education outreach efforts to brokers to develop a much stronger presence in other parts of the country. Because you can't get complacent, and that's rule number 1 in business, right? If you're doing well in certain areas, look harder for areas that you might want to take advantage of, where new opportunities are. The whole hydraulic fracturing industry, energy self-sufficiency is almost here. I wouldn't have even thought of that 10 years ago. None of us would. But Lloyd's is playing in that marketplace. We're not writing the environmental component of it, but we're writing a lot of the contractors, a lot of the E&O around it, and the property, et cetera, that has to go into actually drilling these new types of wells. But we're working hard to try and expand our presence in D&O, E&O, and other lines of business as well. Reinsurance, QBE is the largest U.S. reinsurer, followed by National Indemnity. That's Warren Buffett's company. Lloyd's is number 3. And again, on this slide, a lot of our reinsurance competitors in the U.S. actually own Lloyd's syndicates. QBE is there, Munich Re is there, XL, TransRe, et cetera. So we compete, yet we partner. What does Lloyd's America do? So we don't underwrite, we don't pay claims. We're here on behalf of the Lloyd's market to do all the regulatory affairs work. There are 50+ regulators in the U.S. It's a mind-boggling task that our general counsel and his team in New York, his name is Joe Gunsett, they manage that on a daily basis. We have Glenn Dorr in Boston. He does market development. He's out there educating brokers, policyholders, et cetera, about the Lloyd's market. Rodney Smith is in Atlanta. Hank Fiertzig in the USVI. Tony Joseph, Los Angeles, Western region. Pat Talley in the Central region. We have 32 people in total that work for Lloyd's in the US. And we're essentially, our tagline is to the Lloyd's market who we represent, we're here when you're not. This middle piece is the most important because everyone has a mission statement. It's what you do. But this one is important because we do our best to integrate very closely with AAMGA, NAPSLO, RIMS, and all the other trade organizations in the U.S. that cover everything from small commercial to large Fortune 100 companies. There's an organization for every industry in the U.S. around insurance, and we're tapped in pretty well to most of them. That's how we get the most bang for our very small platform here, is to partner with these folks. Engaging with the communities. Do any of you follow the III, Insurance Information Institute? Do all of you? It's bar none, the best place to go if you're writing a paper or need information on any aspect of the insurance industry, whether it's life and health, property casualty. III.org. Bob Hartwig is one of our biggest fans in this industry. He's a huge advocate of the industry. Whenever there's a disaster, you'll see Bob Hartwig there the next day advocating on behalf of the industry because for those of you who are going into the industry, I'm thrilled because when I started, our industry was terrible at advocating on our own behalves. You know, when there would be major claims, disasters, we always got a bad rap for either not paying the claims on time or not paying claims at all. We didn't have people like Bob Hartwig from the III who was out there educating consumers every day about the industry and how we actually rebuild societies. You know, Joe Plumeri, former chairman, CEO of Willis, had a great tagline. You know, insurance is the DNA of capitalism. And without us, nothing could happen. You hear this every day in school, I'm sure, but my point is III is a great place for information. If you ever need to access white papers, Bob Hartwig does presentations that are 180 pages long. You think mine's bad? He does 180 pages in 35 minutes, but he puts them on his website. Sorry?
Maybe once.
He came here, okay, so excellent, he's fantastic. So I mentioned other organizations we engage with. Schools, I just joined the board of this, of your program here, so we need to fix this slide, don't we? We need to put CIS up there, so sorry about that, but it'll be up there next time. And then corporate social responsibility, we're very big in that. Our New York office is in the MoMA building, Museum of Modern Art in New York City. Every year, a couple times a year actually, we bring in neighborhood kids for about an hour of insurance education. They suffer through it, but at the end of it is a pizza party. And then we take them down to the museum. Just recently, I had a Hiscox underwriter in, and we talked about fine arts in particular. That's a whole cool class of business that Lloyd's writes. And we educated on that for about an hour. Had pizza, went down to the museum and actually saw the fine arts we were talking about. So it's a lot of fun to do that. The Insurance Industry Charitable Foundation, IICF, you all know about them, Bill Ross, everyone else. We love them. And every one of our offices in the US is on one of their local boards. I think it's the best thing going. It helps the general public understand that the insurance industry is a lot more than just the premium takers and the claim payers. You know, we're there every single day of the year supporting our communities through the input of all of us in the industry. So we love that organization. Emerging risks, essentially, it's a risk that we all know is out there, but it's not been studied enough or quantified in a way that you can actually set rates, build policies around it. I mentioned earlier, this is a huge part of what your future is, if you can identify emerging risks and figure out a way to solve problems. On our website, Lloyds.com, we have a whole section devoted to emerging risks. So again, if you're doing papers, feel free to go in there and download one of our PDF papers on CAT modeling, autonomous vehicles. You know, that's the next thing, whether it's drones or cars that drive themselves, that's keeping us all awake at night. Because if there's a claim, like if a car crashes into a tree and you're sitting in the back seat reading the paper, drinking a cup of coffee, and the front seat's empty, you know, whose fault is it? Is it the manufacturer of the car? Is it the software manufacturer? Any number of things that are coming down the pike that we haven't figured out yet as an industry, but we're going to have to. You know, the Arctic opening, we did a great paper on that about a year ago. You know, it's not a good thing, I suppose, that the Arctic ice is melting, especially if you're in Manhattan and the water level is rising and the next big superstorm that comes in is going to do even worse damage. But it's created a huge lift to commerce. You know, hundreds of ships now go through the Arctic passages that couldn't make it before. And there's a lot more minerals now being looked at up there. It's very difficult to drill in that environment, but once somebody gets it straight, there's a huge amount of oil under those ice caps that somebody's going to get. Wow. Autonomous vehicles and drones, I just talked about that. Again, if it weren't for emerging risks, Lloyd's and the entire industry wouldn't have grown over the past couple hundred years from insuring only ships and cargoes to all these classes of business. So I can't stress it enough. It's an exciting business because, you know, no matter what area you go into, whether you're claims, underwriting, management, any number of things in your career, it's an untapped resource that all of us have an opportunity to take advantage of. This leads me into the, I'm almost done, to like 3 minutes. We did a global underinsurance report the year after the 2011 tragedies because we realized that our biggest competitor as an industry is not each other, it's the governments. You know, whenever there are nat cats, you look at Japan, for example, $210 billion in economic losses. $35 billion of that was paid by insurance. The gap was filled by the local government, i.e. the taxpayers. Why aren't we in that game? The Lloyd's paid about $2 billion of that tragedy. Thailand, again, the floods for 6 months, $45 billion in economic damages. The insurance industry paid about $10 billion of that. Lloyd's paid 2.2. Huge gap there of uninsured losses that happened. We know they happened. The government had to pick it up. It goes around the whole world just for 1 year. So we commissioned this study that essentially identified in the red here, a lot of these are emerging markets. These are all the countries we're looking at as big growth economies. You know, Poland, Colombia, Thailand, China, India, all severely underinsured for the types of assets they have at risk. The countries in the green here are the ones you probably most expect as being well-developed insurance markets. You know, Netherlands, they're under sea level, so they're very aware of what can happen when the water levels rise and floods happen. New Zealand, United States, Canada, et cetera, all well insured for their against our GDP. The amount of underinsurance in the world, in China it's $80 billion of premium a year that they would pay to be fully insured as we are in the other more developed countries. Globally, there's about $168 billion in insurance premium that should be paid if you want to get all these countries up to full insurance levels. So for all of you in the room, that's a huge opportunity, not just in the US, but around the world. And lastly, our Vision 2025. Everybody needs a vision for the future. Lloyd's historically has been a marketplace where people came to buy their insurance. I showed you the room there, the face-to-face. Brokers, risk managers for years have gone over there. We've realized that with technology changing the way distribution is done and M&A across the space, there are a lot of reasons why if we continue to sit there in the London market and hope the world comes to us, we're not going to be around in 12 or 13 years. So we've essentially established a plan where we're going to go out to a lot of different countries, set up more licenses. We're opening in Mexico City next year to cover Mexico. And a lot of the countries that are developing or about to develop, we're going to have a much stronger presence in there. We're also encouraging capital investing in the Lloyd's market to come from other countries. China Re partnered with Catlin a couple of years ago, Catlin's a big Lloyd's syndicate. China Re came in, and they're in the next couple of years going to have actually Chinese underwriters in the Lloyd's marketplace there in London writing business. So we're really focusing not just on expanding our own brand across the world, but also getting capital from other countries that haven't historically invested in the Lloyd's marketplace. So a lot of good coming to that. I think I'm done. Yay! Any questions? Anything? I'll make one quick comment. Sorry.
Yeah.
People historically have thought of Lloyd's as the market of last resort. Like you can't get it done there, you can't get it done anywhere. That's not so true anymore. But we pretty much try to insure or reinsure any challenge out there in the world. What we don't do are financial guarantees. So you didn't hear about us during the 2008 financial crisis with those credit default swaps. We don't do financial guarantees because the people selling you that risk will always know more about it than you do. You know, we can study satellite launches, we can study upstream and downstream energy. We know how buildings hold up in windstorms. We can model that, we can set our aggregates against that and make money over time. But financial guarantees, come on, nobody understands them, not even the people selling them to you understand them. So we stay far away from that. My preaching is over. Any questions, or should we get the table set? Yes?
What career path could you offer a very bright student who wants to work in Europe? And I've had several of these over the years.
Well, the challenge with Europe now, particularly the UK, are the visa requirements. So once you get past that, some ways you look for a U.S. Arm of a European company. Munich Re, Swiss Re, any number of European companies have branches here. Go to work for them, and ultimately with the aim of getting over to their home office. That's one way to do it. It's a challenge, though, if you want to go over there as an American citizen, or any citizen really, and go to work for Zurich in Zurich. They just don't offer the training programs like that. Does that help? You work for Zurich here in the U.S., and then ultimately get over to Europe with them.